Welcome to the deep dive. Today, we're really unpacking a complex set of topics around enterprise systems, accounting information systems, basically how businesses manage their data.
That's right. We're looking at how technology drives improvements, but also the critical need for things like processing integrity, internal controls,
hmm
frameworks like COSO, and even touching on newer tech like blockchain.
Yeah, it's a lot, but it's all interconnected, isn't it?
Yeah.
Our goal here is really to synthesize this, pull out the key insights, and help you get up to speed quickly on how these systems work and are controlled.
Exactly. Think of it as a journey from the basics of how data flows through a company to the controls needed, right up to some cutting-edge stuff.
Okay, let's jump right in then. Starting with the foundations, the systems themselves. What are we really talking about with enterprise resource planning, ERPs, and accounting information systems, AIS?
Right, so ERP systems, they're the big picture. Think cross-functional. They try to integrate pretty much all the major parts of a business.
Like sales, HR, manufacturing, accounting, all under one roof, kind of?
Exactly. The idea is to get everyone working off the same information, in real time if possible. They usually have a central database, a common interface. It breaks down those silos between departments.
So data entered in one place, like shipping, is immediately visible to, say, accounting.
That's the goal. It makes things much more efficient and helps with decision-making. And they're usually modular. You might implement a finance module, a supply chain module.
But they work best when they're all talking to each other.
Definitely. The integration is where the real power lies. Data flows seamlessly across the different parts of the business.
Okay, that's the ERP, the big umbrella. Where does the accounting information system, the AIS, fit into that? Is it just part of the ERP?
It can be, but not always. And AIS is more specific, right? It's
Okay.
focused purely on the accounting functions,
Sure.
collecting, recording, storing accounting data.
So an ERP might have an AIS module built in, making it more robust.
Precisely. A big ERP often includes very sophisticated AI's capabilities. But you can also have standalone AIS systems, especially for smaller companies, or maybe ones with less complex needs.
Got it. So who's typically using the AIS day to day?
Primarily accountants, financial managers, anyone dealing directly with the financial transactions and reporting side of the business. Its core job is to take all that raw accounting info, apply the rules, GAAP or IFRS, and turn it into useful reports for decision makers.
And that includes non-financial info too, sometimes.
Yes, absolutely. Things like customer IDs, vendor details, inventory counts, data that's relevant to the financial transactions needs to be tracked too.
Okay, so how does an AIS actually manage all that information? What are its main internal parts?
Generally, you can think of it having three main subsystems working together. First up is the Transaction Processing System, or TPS.
TPS sounds like the workhorse.
It really is. It handles the huge volume of routine, everyday transactions, a sale, a purchase, paying a bill. The TPS converts those economic events into actual financial transactions in the system. Think journal entries.
And it distributes that info for daily operations.
Exactly. It covers the core cycles,
hmm
sales, expenditures, and conversion or production if it's a manufacturing company.
Okay, TPS for the daily flow. What's number two?
That would be the financial reporting system, the FRS. This one's less about processing individual transactions and more about, well, aggregation.
Pulling things together for the big reports.
Right. It takes the summarized data from the TPS, but it also handles the non-routine stuff,
Yeah.
infrequent events.
Like what? A merger or a big lawsuit?
Precisely. Things that don't happen every day but have a significant financial impact. The FRS combines all this to produce the main financial statements: income statement, balance sheet, cash flow for external users and regulators.
Okay, TPS, FRS, and the third one.
The Management Reporting System, or MRS. This one is purely for internal use.
For managers inside the company.
Exactly. It generates reports to help them manage the business day to day. Things like budgets, variance analysis comparing actual results to budget cost volume profit analysis, operational dashboards, information that helps them make decisions but isn't necessarily required for external reporting.
So those three subsystems, TPS, FRS, MRS, they work together. What are the ultimate goals? What should a good AIs achieve?
Well, our sources boil it down to 5 key objectives. The whole system, across all subsystems, needs to ensure that it right. 1. Records only valid transactions, the real events that actually happened.
Garbage in, garbage out otherwise.
Exactly.
Yeah.
2. It has to properly classify those transactions. Debit the right account, credit the right account. Get that wrong, and the whole picture is skewed.
Okay, valid and classified.
3. Record them at their correct value. The dollar amounts have to be accurate. 4, record them in the correct accounting period. That's crucial for accrual accounting matching revenues and expenses.
The timing has to be right.
And finally, 5, properly present the transactions and related info in the financial statements. The end result, the reports, have to be fair, accurate, and follow the required reporting standards.
Those 5 feel like the bedrock of reliable financial information. If the AIS nails those, you can trust the numbers.
That's the idea.
So how does a transaction actually flow through the AIS to meet these objectives? What's the typical sequence?
It starts with the source document, right? The initial evidence of the transaction.
Like an invoice, a purchase order, a timesheet.
Exactly. So first, the data from that source document gets entered into the AIs. This might be manual keying, or increasingly it's automated captured from an online order form, maybe a point of sale scan.
But what happens to the original paper document, if there is one?
Historically, they'd be filed away. But now it's very common to scan them, create electronic images. Sometimes the process is digital from the start. These electronic versions are then stored digitally, much easier than managing paper files.
Okay, data's in. What's next?
The transaction gets recorded in the appropriate journal. Think of it like the first chronological listing. Then from the journal, it's posted to the general ledger accounts and any relevant subsidiary ledgers, like the accounts receivable ledger for customer details.
So journal first, then ledger.
Right. Then, at the end of the period, the system prepares a trial balance, listing all the accounts and balances to make sure debits equal credits.
The initial check.
Yeah. After that, you have the adjustments. Accruals, deferrals, corrections. All the entries needed to get the accounts right under accrual accounting.
Like depreciation or recognizing earned revenue?
Exactly those things. Once those adjustments are posted, the final financial reports and statements are generated by the system.
That whole flow from source document to final report relies heavily on something called the audit trail, doesn't it?
Oh, absolutely. The audit trail is critical. It's the path that lets you follow a transaction through the entire system.
Forward and backward.
Both ways. You need to be able to trace a source document forward, see where it was journalized, posted to the ledger, and how it ended up in a financial statement balance. And crucially, you need to be able to vouch backward, pick an amount on the financial statements and trace it back through the ledger to the journal, and ultimately find the original Morse document that supports it.
Why is that so important, especially for auditors?
It's all about verification. Auditors use the audit trail to get evidence that transactions are real, they're recorded correctly, and processed properly. It connects the final numbers back to the underlying business activity. Without a clear audit trail, it's almost impossible to audit effectively.
And it's particularly relevant for SOC2 audits, for service providers.
Yes, definitely. If a company outsources, say, payroll, the service auditor doing the SOC2 report on that payroll provider needs to see that audit trail. They need to trace a client's input, like employee hours, all the way through the provider system to the final output, like the payroll register sent back to the client. It shows the provider system is processing client data reliably.
Okay, so we've got the systems ERP, AIS, the subsystems TPS, FRS, MRS. We know the objectives, the transaction flow, the audit trail. Now let's get into the specific business processes these systems manage, the transaction cycles.
Right. These cycles are really the heart of the accounting operations, where the transactions actually happen.
And they all kind of feed into each other and into the general ledger, right? Like that diagram in the sources shows.
Exactly. You have cycles for revenue, purchasing, payroll, production, fixed assets, treasuries. They all interact and eventually flow into the general ledger, which pulls the whole financial story together. They also interact with external parties, customers, vendors, banks, employees.
Let's start with the money coming in, the revenue and cash collection cycle. How does the AIS help here?
Okay, so this covers everything from taking an order to getting the cash. The AIS automates a lot. When an order comes in, it can instantly check the inventory records to the subsidiary ledger to see if the items are actually in stock.
Avoiding promising something you can't deliver.
Right. It can also automate credit checks. Based on the customer's history and credit limits stored in the system, it can approve or deny the sale right away.
Speeding things up.
Definitely. Once approved, the system can generate the sales invoice, send an order to the warehouse to pick the goods, and create a packing slip for shipping, often all at the same time. Very integrated.
And when the goods actually ship?
The shipping department logs that into the AIS. That single input triggers a whole bunch of updates automatically. Customer's account receivable balance goes up, inventory quantity goes down, the shipping date gets added to the invoice, the general ledger accounts for sales and accounts receivable get updated. and management might get reports on sales or inventory levels.
Wow, one action ripples through the whole system.
That's the beauty of integration. Then, when the payment arrives, the cash receipt clerk logs it into the AIS, usually linking it to the specific invoice it covers. The system then closes out that invoice, posts the cash receipt to the GL debit cash, credit AR updates the customer's payment history, and generates reports like cash receipts listings.
A very controlled process from order to cash. Now, the flip side. Purchasing and disbursements. Buying things and paying for them.
This cycle starts when someone realizes they need to buy something and ends when the check goes out to the vendor. Again, the AIS provides structure and control. It might verify that the purchase request is for an approved item, or it could display a list of approved vendors to choose from.
Helping control spending and who you buy from.
Exactly. The system generates the purchase order, maybe sends it electronically to the vendor. When the goods arrive, the receiving department enters the PO number and quantity received. This updates receiving reports, checks the quantity against the PO.
And updates inventory and the GL.
Right. And it closes out the PO if the order is complete. Now, when the vendor's invoice comes in, the accounts payable department enters it. The AIS is crucial here for the three-way match.
Matching the PO, receiving report, and the invoice.
Yes. The system automatically tries to link those three documents. If they match with intolerances, it can automatically create the digital AP voucher, ready for payment. It might even schedule the payment based on the invoice due date.
Automating that verification step.
It saves a lot of manual effort and reduces errors. Finally, the system processes the payment, prints checks, or initiates electronic transfers, records the payment, closes the vendor invoice in AP, updates the GL accounts like AP and cash, and generates payment reports.
Another tightly controlled flow. What about human resources and payroll? That seems like a sensitive one.
Very sensitive, lots of confidential data. This cycle is often tightly linked with a separate human resource management system and HRMS. Changes made in the HRMS, a new hire, a pay raise, benefits changes ideally flow automatically into the payroll calculations within the AIS.
So HR updates trigger payroll updates.
That's the aim of integration. Employees might record their time through various methods, time clocks connected to the system, mobile apps, project software. That time data feeds into the AIS.
And the AIS does the calculations.
Yes. It uses the time data and the employee pay rate information to allocate labor costs to jobs or departments, calculate gross pay, figure out deductions, calculate net pay, update employee earnings records, and produce the payroll register. That register then drives the actual payment process through AP and cash disbursement.
Seems like a lot of moving parts.
It is, and accuracy is critical. The AIS generates the summary journal entries for payroll expense and liabilities, linking back to the supporting details, and posts them to the GL.
The Build Pros example in the sources really brought this to life, didn't it?
It did. Build Pros, the construction company, had huge challenges. Lots of employees, tons of projects, high turnover. Tracking labor costs accurately and getting payroll right was tough.
A nightmare scenario without a good system.
Exactly. Their new integrated system helped a lot. It streamlined onboarding. Applicants did more online beforehand. Employees could update their own W-4s or benefits info. And they had that mobile app with the geofence time clock.
Right, employees could only clock in for a job if they were physically at the job site.
Super clever. It ensured hours were logged to the right project code, which linked back to the customer. But critically, there was still a human control point.
The payroll admin review.
Yes. Before processing payroll, the administrator reviewed all the labor allocations logged via the app. This check made sure costs were assigned correctly for accurate customer billing. Only after that review did the system finalize payroll and create the GL export that automatically updated the main AIS.
A great example of tech plus process control. Okay, what about production cycles and fixed asset cycles?
The production cycle kicks off when manufacturing gets a work order. The AIS creates a record for that job in the work in progress, or WIP, subsidiary ledger. As materials are used and labor is applied to that job, the system automatically updates the costs accumulating in that WIP account.
Tracking costs as the item is built.
Exactly. It often uses standard costs, predetermined costs for materials, labor, overhead, and calculates variances between standard and actual. When the job's finished, the system moves the total cost from the WIP account to the finished goods inventory account. And all along, it's generating the journal entries and updating the GL.
Essential for costing and inventory value. And fixed assets. big-ticket items.
Right, machinery, buildings, computers. When a fixed asset is acquired, the AIS is used to create a detailed record in the fixed asset subsidiary ledger cost, useful life, salvage value, depreciation method, location, all the key details.
Everything needed to calculate depreciation.
Precisely. The system then automatically calculates depreciation expense each period based on that info, updates accumulated depreciation, figures out the asset's book value, creates the journal entry, and posts it to the GL. It handles the whole life cycle, including calculating gains or losses when an asset is eventually sold or retired.
Automating a tedious but important calculation. Okay, nearly there. Treasury cycle, and then the general ledger and reporting cycle itself.
The treasury cycle is all about cash management. It's linked to everything else because all cycles either generate cash, like revenue, or use cash, like purchasing, payroll, and fixed assets.
So the AIS helps manage the overall cash position.
Yes, effective cash management relies on that integration. The AIS records cash inflows from deposits, outflows from checks, and electronic payments. It's also where bank reconciliations happen, comparing the GL cash balance to the bank statement. And there are often specific controls built in to prevent cash fraud.
Protecting the company's liquidity.
It's vital. The AIS provides reports on cash trends, receipts, disbursements, maybe even investment performance, helping Treasury predict future cash flows and make sure there's enough cash on hand.
Giving management the visibility they need. And finally, the general ledger and reporting cycle where it all comes together.
This is the grand finale. The GL is constantly being updated by all the other cycles posting their journal entries. At period end, the AIS produces the trial balance. Accounting reviews it, figures out what adjustments are needed.
Like depreciation, accruals we talked about.
Right. Those adjusting entries are posted via the AIS. Once everything is adjusted and the trial balances, then the AIS generates the final financial statements, income statement, balance sheet, etc. It also produces internal management reports, performance reports based on that final data. And it handles the closing process, zeroing out temporary accounts like revenue and expense, and rolling forward balance sheet accounts for the start of the next period.
Wow. Okay, that covers the intricate workings of the AIS and its cycles comprehensively. Now, let's shift gears. How is technology changing these processes? What are the big trends in process improvement using IT?
Well, the core idea is that improving systems means improving the underlying business processes first. Better inputs lead to better outputs.
Makes sense. You can't automate a bad process and expect good results.
Exactly. The goal is always more consistency, more reliability. That leads to better data, fewer errors, more efficient accounting, and better reporting. The sources talk about 4 broad strategies: automation, shared services, outsourcing, and offshore operations. And then 3 specific technologies getting a lot of attention: RPA, NLP, and neural networks.
Let's start with automation. What's the basic idea?
Business process automation, BPA, is just using software to do repetitive tasks humans used to do. The big win is freeing up people from more complex, value-added work that actually requires human judgment.
Letting the robots handle the boring stuff?
Pretty much. But it's not plug and play. To automate effectively, you first have to deeply understand the existing manual process, every step, the information flow, the rules. Only then can you design automation that actually works and improves things.
You need to map it out meticulously first. Okay, what about shared services?
Shared services is about consolidating common functions like HR, payroll, maybe IT support or AP from different parts of a large company into one central unit within the company. That unit then serves everyone.
So the key is it stays internal, unlike outsourcing.
Right, it's internal consolidation. Technology is almost always involved, especially software designed to handle large volumes efficiently.
And the Financial Group Inc. example illustrates this.
Yes, they had 3 divisions: accounting, tax, consulting, each with its own HR, payroll, and legal departments. Lots of duplication. The new CEO saw that and created a shared services center, consolidating all those functions into one central unit.
The main driver being cost savings.
That was a big one, yeah. They expected to save $750,000 a year by eliminating the redundancy. But you also get benefits like standardization and potentially better service levels through specialization.
Okay, that's internal. Then there's outsourcing, bringing in an outside company.
Correct. Outsourcing is contracting with an external provider, paying them a fee to do something for you. Classic examples are using a payroll service or an external call center. The key is that contractual relationship. Cloud-based systems have made this much easier, allowing seamless data sharing, assuming the controls are right.
But it comes with risks, doesn't it? Despite potential efficiencies.
Oh, definitely. The sources list quite a few. Quality risk: the provider might just not do a good job. Quality of service: the contract might be poorly written. Productivity might actually drop. staff turnover at the provider, or losing your own experienced people. Language barriers if it's offshore. Security is huge. You're giving a third party access to your data. Qualifications, are their people really skilled? And labor insecurity for your remaining employees.
That's a sobering list. Lots to consider before outsourcing. And offshore operations is just a specific type of outsourcing.
Exactly. Outsourcing to a provider in a different country. The U.S. company using a call center in India example.
What kinds of things typically get offshored?
Common ones are IT services, business processes like call centers or accounting tasks, software development, and even knowledge work things requiring specialized skills, like interpreting medical scans or complex financial modeling.
Okay, those are the broad strategies. Now for the specific technologies. Robotic process automation, RPA.
Right. RPA is a specific type of automation using software bots for repetitive, rule-based digital tasks. Things that don't need human judgment.
How is it different from, say, artificial intelligence?
It's less about learning or complex analysis and more about doing. RPA bots essentially mimic how a human interacts with software interfaces. Clicking buttons, copying data, filling forms, navigating systems.
Like a digital assistant following a script.
That's a good way to put it. Great for clerical work, extracting data from forms, sending standard reminders. The sources mention web scraping RPA can refine that by applying rules to grab only specific data, not all the surrounding noise.
Useful for bridging gaps between systems that don't talk to each other directly.
Very much so. The source also mentions LiDAR, like in self-driving cars, as related conceptually in how systems sense and act, but for AIs it's mostly about interface automation.
In the logistics example, a company using RPA for invoices.
Yeah, they wanted to automate getting data from logistics, documents, invoices, payment orders into their ERP. It was cheaper and faster to build an RPA bot to do this than train all their staff on multiple systems.
How did it work?
They created a library of all the document formats the bot needed to recognize. They trained the bot on these templates. When documents came in, the bot scanned them, identified the form type, applied rules to extract the needed data fields, and then automatically fed that data into the correct places in the ERP database.
A really practical application. Okay, next, natural language processing, NLP.
NLP is about computers understanding and using human language.
Like Siri or Alexa.
Exactly.
Right.
It lets technology interact with us using speech or text, follow commands, and process unstructured language data. It needs to understand grammar, context, even tone.
What are the accounting uses?
Analyzing large amounts of text. Think parsing contracts to find key clauses, scanning regulatory documents for compliance points, even analyzing transcripts of earnings calls to gauge sentiment or pull out specific financial mentions. It unlocks insights from text data.
Powerful for dealing with unstructured information. And the third one, neural networks.
These are AI systems modeled loosely on how the human brain works, with interconnected neurons.
Trying to mimic brain processing.
In a simplified way, they have input layers, hidden layers where processing happens, and an output layer. Data goes in, gets processed through weighted connections in the hidden layers, and produces a result. The key is they can learn.
How does the learning happen?
By adjusting those connection weights based on experience. They're trained on historical data inputs and known correct outputs. Over time, they refine the weights to get better at predicting outputs for new inputs. They're good at finding complex patterns.
Where are they used in finance?
The source mentions they're often used for fuzzy logic decisions handling uncertainty and are commonly applied in fraud detection. They can analyze huge amounts of transaction data and spot subtle anomalies or patterns that might indicate fraud, things a human or simple rules might miss.
So RPA for tasks, NLP for language, neural nets for complex patterns. Implementing these requires careful change management, right?
Absolutely. You can't just flip a switch. Changes need to be managed methodically, using established approaches like waterfall or agile. It involves careful design, thorough testing, controlled deployment, post-implementation review, and ongoing maintenance.
Okay, that brings us to the controls needed for these systems, particularly around processing integrity. How do we ensure the system is doing things correctly?
Processing integrity is fundamental. It's one of the trust services criteria in SOC 2. It basically means the system initiates and completes transactions correctly. They have to be valid, accurate, completed timely, and authorized. And also covers keeping sensitive data confidential and private during processing.
So the output is reliable and secure. How do auditors spot problems specifically with the design of these controls?
The AICPA definition for SOC2 says a design deficiency exists if either necessary controls are just missing, or the controls that are there aren't designed properly to actually prevent or detect problems related to that validity, accuracy, timeliness, or authorization.
And how do they find those flaws?
By using the trust services criteria as a measuring stick, they look at management's risk assessment, see how the described controls map to the criteria, and judge if those controls, as designed, are actually capable of meeting the objectives.
Can you give examples based on the criteria?
Sure. For security, they look for design flaws in access controls that could compromise data or allow unauthorized access. For availability, they look for design bottlenecks or single points of failure that could stop the system from being available when needed. For processing integrity, they look for ways the design could allow incorrect, untimely, or incomplete transactions. For confidentiality, flaws that could leak sensitive data. And for privacy, design weaknesses in handling personal data that could lead to breaches.
So the criteria provide a structured way to probe the design.
Exactly. We also mentioned using the AICPA's description criteria for SOC2 reports as a benchmark, looking at how management describes its service commitments and system requirements, helps assess if the control design is suitable to meet those promises, especially regarding processing integrity.
Okay, that's design flaws. What if the design seems okay, but the control just doesn't work in practice?
That's called an operational deficiency. The AICPA says this happens when a properly designed control either doesn't operate the way it was intended, or the person performing it doesn't have the authority or competence to do it effectively.
The blueprint was good, but the execution failed.
Basically, yes. So after checking the design, the next step is testing if the controls that are suitably designed are actually working effectively over time.
Performing tests of controls for processing integrity, what's the goal?
To get evidence that the controls operated effectively throughout the period being audited. Did they work as intended? Consistently? Who performed them? If the system changed during the period, they need to test before and after if possible.
Do they still test controls they already know have design flaws?
No, the source says if a design deficiency is identified, you don't need to test its operating effectiveness. No point testing a broken control.
Makes sense. How do they gather the evidence for these tests?
Through inquiries asking people how they do it, reperformance doing it themselves, observation, watching people do it, and reviewing documentation, looking at logs or reports generated by the control. They want to understand how it was applied, how consistently, and by whom.
Timing must be important too.
Crucial. You need to get the evidence before it disappears or gets overwritten. Testing can happen during the period, at the end, or even after, depending on when the evidence is available. Sampling is also key, deciding how many items to test based on control frequency, expected errors, and so on.
What if a control was designed okay, but just never needed to operate during the period? Like a control over firing someone, but nobody got fired.
Good point. The source says if the circumstance requiring the control didn't occur, the auditor doesn't have to modify their opinion just because it wasn't tested. The control didn't fail, it just wasn't needed.
Okay, so when deviations are found during testing, how does the auditor decide if it's a big deal? Materiality.
They gather all the evidence of deviations. Then they have to judge if those deviations, individually or together, are serious enough that they cannot get reasonable assurance that the system is meeting its processing integrity requirements or commitments. If they can't get that assurance, the deficiency is material.
What if fraud is involved?
That raises red flags everywhere. The auditor has to reassess risk. Consider if management's description is misleading. Think about legal compliance. It could lead to deeper investigation, discussions with legal counsel or regulators, maybe even withdrawing from the engagement. It's very serious.
What about incidents outside the system being audited, like a breach in a connected system?
The auditor needs to understand it. Did weaknesses in the audited system contribute? Does it change the overall risk picture? If it was a security breach, was the audited system compromised? They might need to do more testing or look for other compensating controls.
Sounds like complex judgment calls.
It often is. Ultimately, the auditor decides if the deviations found are material. If they are, they have to modify their opinion on operating effectiveness in the SOC2 report.
So, processing integrity relies on solid design and effective operation, tested against frameworks like the trust services criteria. This naturally leads us to the COSO framework for internal control and how it intersects with all this, including newer tech like blockchain.
Right. COSO, the Committee of Sponsoring Organizations, provides that widely accepted internal control integrated framework. It's the gold standard.
And it specifically addresses IT controls.
Yes, throughout its 5 components, but particularly in a few principles. Under control activities, Principle 11 is all about general controls over technology, infrastructure, security, acquisition, development, maintenance, making sure the tech foundation is solid.
Foundational IT controls.
Then under information and communication, Principle 13 emphasizes using quality information, identifying information needs, capturing good data, processing it accurately, maintaining its quality.
Quality data in, quality control support out.
And Principle 14, in the same component, stresses effective communication, sharing relevant internal control information with the board, having separate communication channels like hotlines, using appropriate methods.
So tech controls, quality info, and clear communication are embedded in COSO. The spinal surgery clinic example showed this in practice.
It did. After an IT audit, their improvements directly mapped to those COSO principles. For Principle 11, tech controls, they implemented stronger user authentication for patient records more than just passwords. For Principle 13, quality info, they adopted a data cleansing system to ensure patient data accuracy. And for Principle 14, communication, they started regular IT reviews and monthly control reports to the board.
Clear examples of applying COSO to IT. Now, let's throw blockchain into the mix. First, what's the basic concept from the sources?
Blockchain started as the underlying tech for Bitcoin, the cryptocurrency.
The digital money.
Right. It uses cryptography and a process called mining to validate transactions and add them in blocks to a distributed shared ledger. The key problems it solved were preventing digital counterfeiting, the double spend problem, and creating scarcity, all without a central bank.
What makes it valuable beyond crypto?
Its core features. It's highly resistant to alteration, changing past blocks, is computationally infeasible. Transactions are validated by multiple parties. And it's often decentralized, meaning the ledger is copied across many computers. No single point of failure.
That sounds inherently like an audit trail.
It functions like one in many respects. On public blockchains, anyone can view the history of transactions, the cryptographic links, the timestamps. Auditors can use it to verify transaction sequences. SOC2 auditors might focus on the security of the nodes interacting with the chain.
But there's a catch mention off-chain data.
Yes. The blockchain might record that a transaction happened between 2 addresses, but the real-world identity behind those addresses, or the detailed terms of a related contract, often lives off-chain. You still need controls around that separate data.
And decentralization clashes with traditional regulation.
It can. It operates somewhat outside traditional government control, though regulations are evolving rapidly worldwide. Some ban it, some regulate exchanges, some treat tokens as securities. It's complex.
So how does a traditional framework like COSO apply to this decentralized, immutable technology?
It's challenging. Blockchain changes record-keeping, less human intervention, more automation, immutable records. This eliminates some risks but introduces new ones.
What kind of new risks?
The control environment is a big one. On a public blockchain, your organization interacts with a network you don't fully control. And decentralization itself makes traditional accountability difficult. Who's ultimately responsible if something goes wrong on a network with no central manager? Auditors can't just talk to one party.
Seems fundamentally different. Are there COSO benefits, though?
Potentially. The transparency and data availability could support financial records, maybe simplify parts of audits with the built-in trail, and enable faster reporting.
How would a SOC2 auditor try to link COSO and blockchain?
They'd relate the trust services criteria to COSO principles. For instance, assessing processing integrity on the blockchain might involve looking at COSO's principle for commitment to competence. Do the people interacting with the blockchain have the right skills?
But that decentralization issue keeps coming up.
It does. Principles related to board oversight, P2, or monitoring and accountability, P16, P17, are hard to apply directly when oversight is distributed. Auditors might need to adjust their scope, perhaps focusing only on the organization's interaction controls, or maybe only auditing private, more centralized blockchains where traditional structures exist.
The sources summarize how COSO maps conceptually.
Yes, across the 5 components. Control environment looks at integrity, oversight challenges, structure, maybe cross-functional teams needed, competence, understanding the tech, accountability, key management. Risk assessment considers objectives, assessing unique blockchain risks, fraud risks, needing specialists, managing change, like smart contract updates.
Okay, control active.
That covers controls over the blockchain elements themselves. Nodes, keys, smart contracts, P10, general tech controls, P11, deploying policies for blockchain risks, P12.
Information and communication.
Using quality info, Maybe analytics on-chain data, P13, internal communication, educating people, P14, external communication, like involving auditors early, P15,
And monitoring.
ongoing evaluation, maybe continuous monitoring due to volume, Q16, and evaluating communicating deficiencies, needing talent to spot issues in this fast-moving space, P17.
That shows TOSO is still relevant, but needs careful application. What are the key implementation tips for COSO controls with blockchain?
Focus heavily on preventative controls, because fixing things after they hit an immutable ledger is hard. Increase the frequency of detective controls because of the speed and volume. Consider using other tech like AI or LLMs to help, like automatically scanning smart contracts for bugs before deployment.
Using AI to audit the blockchain code itself.
Yeah, pretty advanced stuff. Also, develop strong policies, especially around KYC and AM compliance in that environment. And crucially, set up clear cross-disciplinary teams with strict segregation of duties, especially around private key management and identifying who's participating. That addresses some of the accountability gaps.
This has been incredibly thorough. We've gone from the basics of ERP and AIS through all the transaction cycles, looked at process improvements via automation, RPA, NLP, neural nets, tackled processing integrity and control testing, and finally explored how COS intersects with blockchain.
It really covers the spectrum, doesn't it? From how information flows and is managed day to day to the complex controls needed, especially as technology keeps evolving. Understanding these layers is just essential today.
Absolutely. And as you, our listeners, process all this, here's a final thought. With technologies like AI, RPA, and blockchain becoming ever more deeply woven into the fabric of business operations, what do you see as the next major hurdle or perhaps opportunity for organizations and auditors in maintaining truly effective internal controls and ensuring processing integrity? Something to chew on as this landscape continues to shift beneath our feet.
A lot to think about. Until next time, keep diving deep.